Welcome back! So far, we considered the three major types of pooled investment products: mutual funds, separately managed accounts, and ETFs. In this video, we will examine hedge funds. Before we start though, we will clarify some of the common legal and fee structures of these investment vehicles. Hedge funds are usually set up and run as limited partnerships, or LP. This type of legal structure includes general partners, or GPs, and limited partners, LPs. GPs are responsible for managing a given investment fund. They have unlimited liability. LPs, on the other hand, are the investors in the fund. They have limited liability and a profit share that's proportionate to their investment. Limited partnerships are usually based in tax-efficient locations. They aren't subject to strict regulations as they are not typically offered to the general public. Instead, LPs are restricted to qualified investors, such as institutions and high-net-worth individuals. These investors are generally expected to have more than adequate knowledge of the market and are therefore able to take on higher risks. The common fee structure of pooled investment funds includes a management or base fee and an incentive or performance fee. The management fee is calculated annually on assets under management, or AUM. The incentive fee, also known as a hurdle rate, is usually calculated on profits above a certain level of return. Another widely used feature is the high watermark. This is the highest net asset value, NAV for short, that a fund has reached and for which a performance fee is paid. Setting a high watermark protects investors from paying fees on underperformance. It also ensures that they won't pay twice for the same increase in NAV. In other words, when high watermarks are in place, fund managers must recover any losses before charging a performance fee on the newly generated profits. For this next part, we start examining hedge funds in more detail. In trying to beat the market, these investment vehicles deploy a variety of strategies, such as the use of leverage, derivatives, and taking short positions. Hedge fund performance is measured either in terms of an absolute return, like 15%, or on a relative basis versus a benchmark index, say 10% above S&P 500. Redemption terms include a lockup period during which investors cannot withdraw their money. The notice period is also part of the redemption terms. It usually lasts between 1 and 3 months. This restriction is posed for a reason. It often happens that hedge fund managers need to exit illiquid positions and convert holdings into cash. The notice period gives hedge fund managers time to do that in an orderly manner. Hedge funds may have redemption fees intended to offset any transaction costs incurred in this process. Okay, excellent job. Our next task is to examine the potential benefits and risks of hedge funds. The benefits are most visible in down equity markets, where hedge funds typically perform better than global equity markets. Low long-term correlation with equities can also provide diversification benefits. Of course, these benefits vary according to the specific hedge fund strategy that is employed. Due to the great variety of hedge fund strategies and the tendency for correlations to increase during periods of market turmoil, we should be careful when generalizing about the diversification benefits of hedge funds. Moreover, doing due diligence on hedge funds can be quite challenging. Overall, these investment vehicles have light regulatory disclosure requirements, and this potentially makes them less transparent. To sum up, when assessing hedge funds, we need to focus on the following questions. What are the strategy and investment processes they use? What are their historical returns, longevity, amount of assets under management, valuation, and return calculation methods? What is a hedge fund's management style, key person risks, and risk management systems? And what are its sources of competitive advantage, reputation, and growth plans? Some of these factors are difficult to quantify. Even the most straightforward ones, like returns, can present challenges to investors. For instance, strategies that have been successful in the past may decrease in effectiveness as more funds start using them. This is the end of the lesson. I hope that you didn't find it overwhelming. Please, feel free to rewind the video if and whenever you need to. Next, we'll discuss buyout and venture capital funds. Stay tuned.